I'm Alan Kenny, Managing Editor with REIT.com, and I'm in San Diego for REIT World 2012, NAREIT's annual convention. Joining me is Steve Buller, Portfolio Manager with Fidelity Investments. Steve, you've been investing in REITs since 1998. That's a long time. What has been the biggest change, do you think, in REIT investment during that period?
I think one of the biggest change is the emphasis on the capital side of the business. I think people assume that real estate is only about fundamentals or supply and demand, but real estate is a capital-intensive industry. So the cost and that access of capital is extremely important. And we saw that in the middle of the global financial crisis. And the second part of the capital is flowing in and out of real estate and REITs as an asset class. That has had a tremendous influence on prices of REIT stocks.
And the issue of Europe continues to be a problem for all industries.
Yeah.
How are European REITs dealing with the uneasiness there?
Well as can be expected. In the UK, they're doing much better, not being part of the European Union. In continental Europe, though, it's a little less rosy. Obviously, the fundamentals are impacted, whether it's office lettings and or the retail side of the business. And we do see most European REITs trading at a discount to our estimated net asset value. I'm actually of the opinion that some of these REITs should actually go away, that the REIT market in Europe should shrink before it has a chance to grow again. That is, there is capital looking opportunistically to invest in Europe. I think it'd be better that some of these get taken over, and hence then shareholders could make money.
I want to talk for a second about growth strategies. A lot of REITs are going about this externally. Can you give us your take on what's going on?
Yeah, acquisitions obviously are very paramount this year and part of their growth strategies. We find that generally that's a good thing. Now that's exploiting their low cost of capital. Obviously we've seen in the debt markets, REITs have a huge competitive advantage of where they can borrow at. And in addition, given what equity share prices have done in the REIT world, we've seen that their cost of capital, both the equity and debt side combined, makes it very competitive to be perversely the highest cost bidder on acquisitions. And those acquisitions have been done accretively, not only to net asset value, but also to earnings per share.
All right, I want you to look into your crystal ball. We're really close to 2013. What's going to be the big story for REITs?
I think another year in a row of outperformance to most other asset classes, which may surprise people given how well REITs have done since March of 2009, for two primary reasons. First, the improvement in the fundamentals due to the limited amount of new supply that we see across commercial real estate. And second is that cost of capital advantage. REITs own approximately 10% of all commercial real estate in this country. The ownership of that real estate is generally at a much lower cost of capital than that other 90%. And they're exploiting that cost of capital advantage through acquisitions.
All right, well, thank you very much for your time, Steve.
Thank you.
And for more on this and other news and analysis from REIT World 2012, be sure to check out REIT.com.